On today's show, you're going to hear from one guest that a correction is coming, but it's not the correction you think is coming.
There's likely to be a correction of some sort, and most people think of correction in terms of price. But from a technical perspective, you can see a correction in time, meaning the market may try trade sideways. I think absent of any kind of big geopolitical event or policy change from the US administration, we're more likely to see a correction in time and really letting some of the fundamentals catch up to recent price activity. So we like that time correction more than price correction.
That's Matt Harris, Chief Investment Officer at the Hausberg Group. He's here talking technicals, and he thinks the market is setting up for a long period of sideways. But that's very different from we've had a big run and now we're going to back off. In fact, he'll explain why he doesn't think that's what's likely to happen. But up first, Greg McBride, Chief Financial Analyst at Bankrate.com, is here to preview the Fed meeting this week. And no, he's not thinking the Fed's going to cut rates yet, but he is thinking that's coming, and he's got strong opinions about what he thinks that's going to do for the entire rate picture. Plus, Dean Miyakawa, Director of Managed Investment Solutions for Westwood Holdings Group, is here talking macro big picture and the benefits of investing in countries based on democracy rather than autocracy.
All right, let's roll.
We are rolling indeed. This is Money Life for July the 29th. I'm your host, Chuck Jaffe. Thank you so much for joining me. I love the discussion you're going to get today where we talk about a time correction. Yes, but you also get perspective on from Matt Harris on why the rally that some people were about, like, wow, we're up so much. He puts a longer lens on it and says, maybe you don't need to be so nervous. But you'll get crossover between that interview and the first one we've got today with Greg McBride because, well, we're talking about the Fed and we're talking about rate cuts and more, and it all kind of pieces together. So this is a show, I have to tell you, it kind of came together a little bit last minute. Matt Harris was going to be on the show, but we had other things planned and some things went kaflooey and whatever. And I've told you that the summer can be a difficult time to book the show. Like, ironically, the times when people think it would be most difficult are usually pretty easy. But summer, when you're in the doldrums and a lot of people are traveling and out of the office or whatever. So we moved some things around, and I think we've got a great show for you. And that is one of the reasons why I love having you here, but think you should check in with us every day. It's not just the days where you go, oh, I recognize that name. That guest is great. I want to go and hear them. Although we've got those guests coming this week. Guys like Frank Holmes from U.S. Global Investors, Paul Gruenwald from S&P Global, and more. It's not just that you might want to hear them. It's that the rest of the time, there's some interesting people to hear from. And I think today's show brings that to you. One thing I was not able to get into this show was a little bit of follow-up on the trade deal with the European Union. But one thing that came out that I think we have to watch for is whether or not the math works. Because you can say, hey, I've got a deal and this is what's going to happen, but does it make sense? Critics have been saying, in this deal on tariffs and trade with the European Union, Brussels agreed to buy $750 billion of U.S. energy products over the next 3 years. But energy experts have been saying that for that to happen, U.S. energy product exports to the European Union would have to more than triple. U.S. energy exports to the European Union were under 80 billion, not far under 80 billion, but under 80 billion in 2024. About the same as they were a year before that. So to get to 750 billion, EU would basically have to more than triple what they're doing for the next 3 years. Now, I don't know what that winds up doing for the trade deal and the rest. I cannot pretend. And I am not saying this means that the deal is horrible. I'm just saying that one of the things we have to look at is, does the math work? Because it's not about the political party. I wouldn't care who's making the deal. But the numbers have to work on the face of it for me to go, oh, that's actually a positive. So we'll be watching that, I think, in the days ahead. We'll try to see if we can't get somebody on the show to discuss a little bit more of that. But if you've got folks that you think, hey, they should be talking on the show, don't be shy. Chuck@moneylifeshow.com is how you reach me, and I would love to hear from you. Right now, however, I want you to hear from our guests. And again, it's a great show today, starting with Greg McBride, then Matt Harris from the Hausberg Group, followed by Dean Miyakawa from Westwood. We'll kick things off going off the news on rates, setting you up for the Fed meeting when we really get the talk rolling in a moment.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
We start today's show digging into the news, and it's not the news that we've had before, although we have talked about these issues before. It's the news that is coming this week because we are looking at a Fed meeting this week. And yeah, with the Fed talking, we've got to talk about it. And there's nobody I would rather discuss Fed actions with and what it means for banking and what it means specifically for a lot of the pocketbook issues than Greg McBride. He is chief financial analyst at bankrate.com. You can find him there. His work is there as well. You can check out rates on any of the financial products you need. And of course, Greg was for a long time a regular, not just on this iteration of Money Life, but on the original Money Life as well. So it's always a good day here on Money Life when I get to say, Greg McBride, welcome back to the show.
Great to be with you, Chuck. Thanks for having me.
You know, we talked about 7 weeks ago, the last time the Fed was getting ready to meet. And at that time, we expected nothing to happen, and ho-hum, nothing happened. I'm not sure that we're expecting the same, but what you said at that point was that you thought we would see the Fed reducing rates in the second half of the year, once, maybe twice, based on a weakening job market. But you also said there was nothing compelling in June that would make them cut then. Is there anything compelling now?
No, and they won't cut rates because of that. Unemployment's at 4.1%. Inflation's still closer to 3% than 2%. A lot of uncertainty about the impact that tariffs could have on inflation. Could it push inflation higher? Is that going to be a one-time blip? Is it a more sustained thing? All those open-ended questions. What the Fed is going to do, just sit back, evaluate data. They want some clarity on those aspects before they decide on their next move. So, when we were talking back in June about one, maybe two rate cuts in the back half of the year based on a weakening job market, yeah, I still think that's probably the most likely outcome. We're not really seeing that weakening in the job market yet, but the labor market has softened a bit, but not to the point where we're seeing jobs being lost as much as it's just we're not seeing as many added.
I said back in June, but I've repeated it since, that I don't actually think we're getting rate cuts this year. I think we're going to see a little bit more in the way of impact from tariffs in the second half, and that's going to balance out whatever we've got, and they're going to stand still.
I think you could easily make that case. And I think that's a fairly decent probability as well. So not far-fetched at all. It's not hard to sort of sketch out a scenario where that's how it unfolds.
As for inflation, obviously it is one of the big things that people are worried about and freaking out about. We have talked to some experts on Money Life who said that it's not just that people were waiting for certainty, what was going to be the tariff levels. It was also that companies didn't want to really be the first ones to raise prices ahead of tariff certainty. What that means is that they think that once we get some certainty on tariffs, which we now have with Europe as of the trade deal this past weekend, et cetera, then we'll see the price increases because then they know what to do and they can say, hey, I'm doing it in response. I'm not doing it ahead of while we're just uncertain. If that's the case, then tariff inflation shows up. So are you in the camp that tariff inflation is coming, or are you in the camp that tariff inflation is not going to be as bad as people had projected it, which is another school of thought out there?
Well, I'm in the camp that it's coming. Where I'm unsure is just how bad is it or how tame is it, right? I mean, but it's coming. These are real costs that are going to have to be absorbed. Businesses are in a position, particularly larger companies, with pretty stout profit margins, they're in position to absorb some of that, but let's not kid ourselves. They're not going to absorb all of it. And smaller businesses that don't have that scale, they're not in a position where they can absorb very much and stay in business. And so those costs are more readily passed along. So the end consumer is going to end up paying these in some way, shape, or form. And we're going to see more of that as we get more of that certainty that you talked about, and just also as that tariff tally starts to rack up here in the back half of the year.
One of the things that we have seen, of course, is a lot of pressure being put on Jerome Powell to act. But as you and I have discussed before, the rate cuts that we had last year did not particularly turn out the way we normally expect rate cuts to go. I have talked to plenty of people who say they don't think rate cuts will turn out as expected this year. I'm about to talk to one in a few minutes who I know believes that some of the rate cut stuff is already priced in, which will mute the impact. And when I said that's in the next interview coming up after you. So are you in the spot where rate cuts, like if we had them, President Trump would be looking at that going, see, I told you this would happen? Or are we not going to get what people think comes with rate cuts?
When we get rate cuts, and this goes back to what you and I were talking about a few minutes ago, where I was saying, one, maybe two here in the back half of the year, although could easily play out to your scenario, we get zero. But let's just for the sake of conversation say we get one or two. That is not a meaningful decline in interest rates. I mean, that's really not going to make much difference. I mean, you figure we saw interest rates come down a full percentage point late last year, and credit card rates are still over 20% on average. A lot of home equity lines are still in double-digit interest rate territory. I mean, rates are still high. So yeah, we get one or two rate cuts, in the back half of this year, rates are still going to be high. I mean, put it this way, when the Fed raised rates in 22 and 23, that basically took the elevator from the ground floor up to the 55th floor. Well, last year, we walked down the stairs all the way to the 45th floor. So, if rates come down once or twice and we go down to the 42nd floor, or even all the way down to the 40th floor, the view is still pretty good, right? I mean, we're still way up there. We're not going back to those, pandemic era, really low interest rates. And interest rates took the elevator going up, but they're going to take the stairs coming down because the Fed is going to move at a much slower, much more deliberate pace, which is what we're seeing.
There is still a ton of money, like $7 trillion in money market mutual funds. Have we seen consumers also holding more money in banks? And does bank money ever get off the sidelines the way we sometimes expect money market money to get off the sidelines?
Consumers are taking advantage of these higher rates, high yield savings accounts. A lot of retirees are in a position where they can lock in attractive returns on things like CDs or high quality bonds over a multi-year horizon and really lock in some attractive interest income. And Chuck, we went decade and a half without being able to say that, right? And so, it's a real welcome change from the standpoint of savers and retirees. And so, yes, definitely taking advantage of that. You mentioned the $7 trillion in money funds, and money funds right now are earning over 4%. At least those with the lowest expense ratios. So there's no harm in having that money in cash. It's producing a rate of return that's ahead of inflation at this point. At the point where interest rates are lower or interest rates are no longer ahead of inflation, does some of that money in cash come out and go into other risk-seeking investments? Yeah, eventually. But that 7 trillion in money funds, it's not going to go to zero. I mean, there's a lot of money that would move under a scenario like that. But even then, I'd be shocked if you saw that tally get much below 5 trillion.
What are we seeing consumers do in response to what's been going on? We know that all the soft data says consumers are really unhappy, even though the economic fundamentals are good. So you guys are always taking a look at this. Nobody likes high cost debt. Credit card rates, et cetera, have been super high. Are consumers who are complaining about prices and the rest actually making headway on their debt?
The headway is a little tough to measure at this point. From a standpoint of game plan and intentions, most people say they're focusing really on two fronts, both paying down debt and savings, not one or the other, but both. And it just kind of illustrates how many people are in the position of they've got a little too much debt and they don't have enough savings, but that they're working on tackling both of those at the same time. And that's really leaning into this rate environment that we have. Rates are high. It's costly to borrow, but it's good to be a saver. And so leaning into that means pay down that debt, lighten that debt burden, but also pad the savings, give yourself a little bit more financial wiggle room. And that way you're better prepared. If you have more savings and less debt, you're better prepared for whatever the economy may throw at us.
That, of course, is the advice that we want to give. We know that consumers are horrible at following that advice. Are they actually getting it done this time?
The biggest obstacle to, I mentioned how it's sort of difficult to measure whether or not there's much headway being made. The biggest obstacle consumers point to, 68% of consumers say inflation and high prices have been the major obstacle as to why they haven't been able to make headway, particularly on the savings side of that. So, there's been different obstacles at different times. There's long been an intention to boost emergency savings, but as you and I have talked about over the years, we really haven't seen that needle move very much. And then, the current state of affairs, just the high price tag on so many things, how that stretched household budgets, that continues to very much be an obstacle in boosting that much needed savings cushion.
I want to finish this interview coming full circle since we started talking about the Fed and we expect no particular action this week. Well, we know who that's going to upset, which ironically is not those of us who are consumers or investors or what have you. We've got it priced in. It will affect the one person who has spoken more about the Fed than any other. Are you worried at all about this idea? Not that Jerome Powell will get fired, but that you could pick his replacement early. And if so, does a shadow Fed chairman create issues that have a bigger impact than just, I want you to make sure that somebody's sitting over your shoulder so you cut rates?
That's a concern, but I think just more broadly, the tendency to erode the effectiveness and independence of the Fed is something that really we should all worry about. Countries that have an independent central bank have, over time, shown a tendency for lower inflation, more sustained economic expansions, and higher levels of employment. Countries that do not have an independent central bank, they are more likely to have higher inflation and to have more frequent and deeper recessions. We know which one of those two camps we want to be in and which one we don't.
Well, whatever camp you're in, that's the camp we want to be when we are camping out to watch what the Fed is going to be doing. Greg, we really appreciate it always when you're on the show. Thanks for coming back and joining me one more time.
Always a pleasure, Chuck. Thanks so much.
That's Greg McBride. He's the chief financial analyst at Bankrate.com. Go to Bankrate.com for more information on all things rate related, not just the news stuff, but also, what kind of rates you can get as a saver, a spender, a borrower, all that stuff. And we're just getting started on the July 29th Money Life. Up next, I'm talking technicals with Matt Harris, Chief Investment Officer at the Hausberg Group. And then it's big interview time with Drew Miyawaki from Westwood's Managed Investment Solutions team. Stick around. We're living the money life. And there's much more to come.
VettaFi is the partner asset managers rely on across the entire product lifecycle. Learn how you can build and support the product of your dreams at VettaFi.com.
Don't get technical with me.
But enough of my technical mumbo-jumbo. Allow me to demonstrate.
Welcome to Talking Technicals here on Money Life, where we dig into the numbers with, normally it's certified market technicians, CMTs, and other guys who really take a look at everything that's going on in the numbers to try to figure out what's happening next. And one of the people we like because, he does look at the numbers, but he also looks at the fundamentals, is Matt Harris. And Matt, Chief Investment Officer at the Hausberg Group, formerly with Hightower Advisors, which the Hausberg Group is part of, but he was with the bigger organization. And you may recall that Hightower was a sponsor of the show for a long time, and we worked a lot with Hightower Advisors. If you want to find Matt now, Hausberg, HAUSBERG .HightowerAdvisors.com. Matt Harris, great to have you back on Money Life.
Good to be back, Chuck.
We got a market that's flirting with record highs. It is climbing the wall of worry. Are we more likely to keep driving the highs, or do we need to take a break here?
I think that's a question that a lot of investors are asking themselves right now because it's been a really interesting year so far. Lots of news, lots of headlines, lots of uncertainty, and really the news cycle moving markets in good or bad directions, and people really extrapolating, the smallest information out into a much bigger news item for markets. So it's really made some trends stay in place. It's put some new trends that we hadn't seen for a while in the forefront of investors' minds, like international stocks outperforming the US for the first time for a while. I'm a little bit biased because I am a technical analysis, but I think years like right now, or periods like right now, where there is a lot of news driving the markets, it's a good time to be looking at price and really paying attention to the details and the facts from the market and not just paying attention to all of the news that's out there. So I do think it's important to be paying attention to all of it right now. But when we're looking at the market, we go back 3.5 months to the April low to really set the stage for what's happened because we've had great performance since then. But a lot of people are looking at that performance alone and saying maybe it's time to take some off the table because the market's gone up roughly 30% since early April. When we zoom out and look at the last year, the market's up roughly 15, 17%. So it's good, but it's not too far too fast. This type of 30% move from the low, this is generally what you see off of a market bottom. So it doesn't concern us too much. And in fact, after the second quarter was so strong, we looked at performance following a really strong quarter, and we measured that by a 10% gain from the S&P 500. The next quarter typically is a little bit better after than the average quarter since 1950. The following 6 months is much better, typically up 9.5% over the next two quarters versus 3.2% on any average quarter. So we like to be on the right side of history. That doesn't mean that it can't be different because these statistics aren't accurate 100% of the time, but we like to be on the right side of history. So with that said, we also are mindful to the potential for a weak seasonal period. Really the August, September, October period tends to be a little bit more volatile than some of the rest of the year. So we're mindful to that, but right now we do think that there's a little bit of a bias towards up versus down on a go forward basis.
A little bit of a bias. How much room do we actually have to run? Because a little bit of a bias would be great if we wind up adding, say, 5%, and that takes us to the end of the year. If it's 5% and it takes us to those August doldrums, and then we get to the fall and we have a September, or October to remember, Octobers to remember are the kind of thing you really don't want to live through. It's a very different story. So, is there anything that's scary on the horizon, or we're kind of range bound, is what it really means?
Yeah, I think there's likely to be a correction of some sort, and most people think of correction in terms of price. But from a technical perspective, you can see a correction in time, meaning the market may try trade sideways. I think absent of any kind of big geopolitical event or policy change from the US administration, we're more likely to see a correction in time and really letting some of the fundamentals catch up to recent price activity. So we like that time correction more than price correction. And this is because some of the technical indicators are again biased bullishly. When we look at leadership in the market, it's much more cyclical than defensive. The one defensive that's leading is really utilities, and this is because of the power consumption or from AI and really a derivative of the AI trade. Generally, volume breadth is again bullish. There's more companies participating in the rally. Really, it was the Mag 7 and the AI names for quite a while. And really, the S&P 493 has really caught up with the equal weight index, looking to break out to all-time highs as well. We're seeing a lot more participation in the market these days. And then again, what's on the sidelines has been pretty meaningful in terms of cash. Now, this hasn't helped the market yet. It's more fuel to the rally eventually. When we look at money market assets, in 2020, really the depth of the COVID crisis, there was about $4.8 trillion in money market assets. And that was a new high for money market. Today, it's roughly 7 trillion. Obviously, there's a big difference between now and 2020 in terms of interest rates and the amount of interest you're earning from the money market. But at some point, either when the Fed starts cutting rates and money market assets yield less, or the earnings just continue to improve, and investors say, I can't miss out. A lot of this money market assets do need to get put to work in longer term assets, whether that's bonds or stocks to be determined. But we know if the market's going up, it's more likely people chase those good returns from equities. So we do think that's going to be a potential further fuel for the fire, not in the immediate or short term, but just longer term as the news cycle continues to stabilize. There's not as much uncertainty related to trade policy or really geopolitical issues in general. we could see some of that money put to work in equities and really be fuel for continued growth.
So if I have to put this together from your last two answers, a time correction, a slowdown a bit, upward pressure coming once we get money being put to work, especially once the Fed cuts rates, would mean any sort of decline, at least for the time being, that correction that you're talking about becomes a buying opportunity, but I have to be patient. Like it's not necessarily that I have to wait to buy in. It's just that it's going to take a little while for the buying opportunity to prove that it was a buying.
Yeah, I think that's very accurate, and I think that's where investors often can get tricked into selling too early. They want immediate gratification, but we know investing takes a while. It should take a while for returns to be generated. It shouldn't be put money to work this month and then 3 months later I've made my returns. We want to be looking to long-term assets and really be positioned for the next 1, 3, 5 years, not 1, 3, 5 weeks or months. So I think you're spot on. Put money to work over time as there's uncertainty and volatility, and you'll get paid back over the next couple of years.
Let's talk a little bit about when you think the Fed is going to cut rates and what you think the impact will be separate from the money market stuff. The last time the Fed cut rates, we didn't get all of the things we expect out of a rate cut. Are we going to get it this time? And as somebody who is looking at the markets and going, normally when the Fed cuts rates, this is what I expect, is your anticipation like a rate cut would be a boon to the market at this point?
I'll answer that last part first. I don't think it's going to be as impactful as they have been in the past because there's been a lot of anticipation of the rate cut. I mean, it's what the market is focused on most. There's news about President Trump and Jerome Powell. It seems like every other day on what's going to happen there. So it does seem like there's a good bit of future rate cuts priced into the market already, which will mute some of the expected results, but it's likely to see some cuts in the fall. Yeah, I think the market's been extremely volatile in what it's expecting for rate cuts really for the last couple of years. There's been times where the market expects, 7 or 8 rate cuts in a 12-month period. There's times where it's one or two. It's been really, really volatile. But now it seems it's more reasonable looking at 3 to 4 cuts over the next 12 months. This seems about right, one a cut or two every 3 to 4 months. So we would expect in the fall there to be one cut, and then we'll see how it goes. But the Fed is data dependent. I think they've got enough to argue for a cut sooner than later, and enough to argue for pushing them down the road. So I think this fits in the uncertainty category, but likely whether it's September or December likely doesn't make that big of a difference to the market results.
As you look at, one of the things you talked about was the fact that Europe has done so well. We have had folks on this show who have said this is the time to be diversifying to Europe because you're going to see it continue to do well. We've had others who have said that's the Europe rally. That was it right there. I should point out that, among the things that you do, you are an asset allocation strategist. So how much are you leaning into Europe right now, given what's going on, or how much do you think the story's played out?
It's an excellent question, one that we frankly struggle with all the time right now because for the first time in a long time, Europe and emerging markets have been doing well and outperforming, but we always do have an allocation to international developed emerging markets. It's usually 20 to 30% of an equity portfolio, so it's underweight versus the global market capitalization. But we know and understand that because we prefer the risk profile of U.S. stocks versus outside the U.S. They're just less volatile, so we do make that preference. But we're not adding to international or emerging markets right now because we do think the rally has been pretty strong. The dollar is starting to look like it could stop its downtrend, and if so, that has a meaningful impact on non-U.S. assets. But that's still to be determined. We just don't think we need to add to this trade because historically the outperformance of international or emerging markets usually is pretty short lived. It's not a multi-year rally. It's usually 6 to 18 months, give or take. So we're on the in the middle of that, we don't need to be adding too late at this point.
That being the case, where are you heavy right now? And how much, given that you see a time correction, how much is it really getting people to be patient versus telling people, bonds are doing really well right now. You can lean into bonds and feel pretty good. Collect your coupons while you wait.
Yeah, I think we're still overweight. We've always had a bias towards growth-oriented companies. I think that's where we are still looking today, but more growth at a reasonable price or GARP. And this really means for listeners that aren't as familiar, companies that are growing and are definitively growth companies, but aren't you're not paying a extremely high multiple. They're not the ultra expensive companies. So this does leave out some of the AI or tech-oriented names, but that's by design. This is more how we think about our core part of our equity portfolio, not necessarily the growthiest part, but that bias to have a little bit more growth is one area that we think makes sense both if the economy slows down further, but then also just over the long run, having companies growing their earnings in high single digits to low double digits, that's attractive regardless of the macro environment. So we definitely are overweight growth and really growth at a reasonable price right now. To your other question, it is staying patient, and I think we're fortunate that a lot of our clients are sophisticated and understand the difference between adding to bonds for the safety and stability right now, and the long term growth potential of stocks. There, everybody has a balanced portfolio, but they have been very patient or willing to be patient to invest for the long run and really take advantage of some of the volatility that we see in equity markets instead of just throwing in the towel and saying, let's just go to bonds because we want, more of a consistent profile. We know if you invest for the long run rates of return we get from equities will be realized over time. We don't need to make too many changes, in the short term for safety or comfort.
Matt, great stuff. Always is when we get a chance to catch up. Thanks so much for taking the time. I'm looking forward to us talking, which will probably be early in 2026 as we watch it all play out. So stay well, come back to us. Looking forward to that one.
You too. Thank you, Jeff.
That's Matt Harris. He is Chief Investment Officer at the Hausberg Group, part of Hightower Advisors. Go to Hausberg, Hausberg, hausberg.hightoweradvisors.com. Nothing technical about this. We'll take a quick break, and Money Life will be right back. Welcome to the big interview on the July 29th edition of Money Life. Joining me now, Drew Miyawaki. He is Director of Managed Investment Solutions at Westwood Holdings Group. Now, if you want to learn more about the firm, it's westwoodgroup.com. If you want to learn more about their managed investment solutions and the team that Drew is part of, we have a direct link in our show notes on our guest page where you can find Drew. What I will tell you is, while his title may not mean much to you, and I will actually ask him a little bit about what he does, which I don't do very often, the bigger point is the managed investment solutions team kind of looks at everything, big picture, and then tries to figure out what they're going to be doing, whether it's an allocation standpoint, it's a strategy, whether it's going to be systematic or it's going to be customized, all these sorts of things. And so there's an interesting take that we're going to get from him on what's been going on. Drew Miyawaki, thanks so much for joining me on Money Life.
Thank you very much, Chuck.
I will just point out, I hate your title. I hate having to ask a question about titles, but in your case, because we're not just saying, hey, you're a portfolio manager, et cetera, I want to make sure that my audience does understand what it is that you do and why you would have a take on macro and geopolitics and all the things that we're going to discuss. So help everybody else understand what it is that we're talking about when we say you're, part of the managed investment solutions team for Westwood.
See, we made those titles by design so that you would ask that question. Yeah. So we're glad it worked. Managed investment solutions, what does that mean? It's a team that has an extensive history in creating customized solutions for investors' unique goals and objectives. So we as a group like to get into the weeds, get into the design, get into the real detail and the methodologies that can support solving for clients' goals and objectives and what they're trying to achieve from an investment standpoint. So we were primarily index driven. We like the rules based, transparent approach that index provides, but we like to be really involved and consultative in the design process of that, helping investors choose the correct methodology, design, the correct index provider, the correct universe, and all the details that go into indexing. Indexing obviously has grown substantially over the last couple cycles, and what we've seen is that clients don't have to pick off the shelf anymore. They can be actively part of that decision process and that design. So we hate the word passive, but we like the active design component and a passively managed index transparent vehicle.
Yeah, it means you do some direct indexing or custom indexing, things along those lines. And so my audience has heard me talk about, there's actively active and passively passive. This is some measure of being actively passive. In other words, active management layered on top of an indexing structure, et cetera. So now you've got an understanding of where Drew is coming from. Let's take a look at what it is that you're seeing happening broadly, because we've got tremendous amounts of uncertainty, but the market has just kind of kept pushing forward and rising. And in fact, for all of the customization and the moves that people can make, it's been pretty good to just kind of sit in that large cap portfolio that most people had. Maybe you missed out on a little bit where you weren't enough international or what have you, but it's been pretty good for folks who have been taking the average not custom portfolio. Does that continue, or is the trouble that people think might be on the horizon actually going to show up at some point?
What we've seen recently is investors are concerned about a number of different things, but one of the common themes that has come up recently is this idea of potential risk of Chinese exposure within a portfolio. And we've seen it from different sort of motivations. We've seen, state governors and audit boards demand that China be divested from public pension funds. We've seen kind of a groundswell from the retail investor that they want to limit their exposure to China amidst all this kind of geopolitical turmoil that they're anticipating and they're seeing. And so when we started off on this journey of coming up with a creative and well thought out solution for this problem, it starts with the idea that the investor wants to remove China from their portfolio. But again, some of the solutions that were available on the market currently were pretty blunt. They just removed China at the direct country level and didn't buy any equities that were listed or traded in that one geography. If you take it a step further, you're concerned about China. Maybe you should be concerned about Hong Kong. Should you be concerned about that region in general? And it's a relatively simple exercise to take away the exposure directly. But what about all the indirect exposures that are in your portfolio? That takes a much more nuanced approach, a much more careful understanding of all of those intricacies and dependencies that the rest of your portfolio, your French equities, your U.S. equities, your Canadian equities, Japanese equities, et cetera. How many of those equities are highly exposed to the region you're trying to avoid? So if you're trying to avoid a region for a specific reason, just doing the direct removal is just the surface. We think there's a whole lot more risk that's under the surface. If you think of the iceberg metaphor and illustration, it's what's under the waterline that you can't see that is potentially more dangerous than what's above the waterline that you can see. And as these markets become more and more intertwined and more geopolitically driven, we start to see this not just in China, but in other markets as well. Being involved in indexing for so long, we've realized that when a country gets itself in trouble, and the most recent largest example of that is Russia, the index providers generally wait until it's too late. It's very reactive. And then they react by saying that a market is now uninvestable when previously they considered it investable. So Russia was fine until it wasn't. And then it was removed, and it was removed at a zero value from all the global indices. Now, that really, paralyzes a portfolio, especially one that's global and multinational. So the strategy that we've come up with looks not only at those direct investments at the country level, but also the indirect investments throughout the rest of the portfolio. And it's not just considering one nation, China, it's considering many nations that are not free, that are non-democratic, And again, looking back over history, these are the countries that tend to find themselves falling out of the indices over time. We've seen it with Russia, Pakistan, Venezuela, Argentina. These are all non-free, non-democratic countries. They all are fine when they're in the index and everything is stable. But when that instability surfaces and the market is deemed uninvestable, now they find themselves out of the index, and the index has to react rather than be proactive.
We are expecting more clarity on tariffs this week. We've had some as the deals were cut with the European Union. How do you think that's going to impact the market? Because what we've seen, of course, was when the initial announcement came, massive market moves. Each subsequent push it back a little bit, make an announcement has seen the market react to where the stuff we saw at the beginning of July, the market didn't even pay attention to it barely. So I'm not sure what's coming next, but for you, is the announcement or the reality like, hey, now that we have clarity and certainty, it can be fully priced in and that's what'll move the market?
Yeah, and I think that's one of the reasons that people are drawn to these index type methodologies. And if they're part of the active design of it, they really understand what they are getting in their portfolio. And it's not an active fund manager making these decisions on very unclear information. There's a clear and transparent rules-based methodology that the investor can lean back on and have that level of comfort with. None of us know what's going to happen next. We all kind of live in a world that's, a social media post away from causing a significant market turn. So to, again, look through the portfolio and say, okay, we're going to think about things in a country level, but also not just at a direct investment in that country level, but also the indirect exposure to that country as well. Those are the nuances that need to be considered throughout that portfolio. And I'm not quite sure that, many investors look past that first level. So, hopefully with this strategy, this solution, it's a thoughtfully designed methodology that investors can clearly understand what it is that they're getting, and then have the comfort to move forward over time with that methodology.
I'll play a little devil's advocate here because obviously you are dealing with high-level customers who the nuances matter. If I ran a significant chunk of money for clients or what have you, every little bit I can squeeze out of it is particularly important. But if I am Joe, the slightly above average investor who wants to make sure I've got all my allocation bases covered and wants to make sure that I'm not going to get too buffeted by whatever storms happen next, but I'm also going to participate, I don't know that I have to get this granular. So that is the question. Like, it makes sense for you to do this, but at what level does it make sense for the average investor to say, I need to be this complicated or this aware in my portfolio rather than doing it with maybe a blunter object or a blunter instrument?
It's funny you mentioned that. Just last night I was talking to someone at a little bit of a house party, and he was asked what I did, and then I explained it very high level, and he said, well, I've got some money over with this guy, and I actually don't really know what I've got. I know it's been doing all right, but I don't really know what I've got. And it just kind of got me thinking that there are many investors out there that are probably very similar to that person. And, this is a very conceptually simple way for you to understand what you do have. You have a portfolio that looks and feels like a global allocation to the all country world index. So you're getting international, you're getting exposure to developed and emerging markets, as well as, of course, the US and other highly capitalized markets. But you're getting exposure to the companies and the countries that are most democratic within them. That's the headline. And over time, you can get into the detail about it, but democracies outperform autocracies over time. And there's academic basis for that. So if you're going to invest, you should understand where you're investing, of course. But the countries and the companies that you are investing in, they're highly exposed to democracies, should outperform those that are not.
What kind of performance changes or alterations or risks are there when you have the kind of policy uncertainty that we have and how it is impacting, the globe? Because we're not used to seeing too many time periods where foreign central bankers have been cutting, but the Fed hasn't. We're not used to seeing too many things where one particular party is driving so much about policy. And oh, by the way, we do have a couple of wars going on, although they're having virtually no impact on the broader markets, apparently.
Yeah, we've seen this strategy be adopted by folks that are looking to now dip their toe back into the international markets. And so, especially for U.S. investors, they've had that home country bias for a very long time, and it's served them well. They've been handsomely rewarded for that allocation to the U.S. Many investors now are looking to move into the international markets, and we think this is a good way to do that, knowing that you are moving into international markets that are democratically based. They're free markets. They have free flows of information. They have certainly a much better history of human rights versus the countries that are excluded, which are kingdoms or autocracies or under some kind of authoritarian rule.
When it comes to what you see happening in markets, so much has been done by so few participants. We have seen this massive skewing towards the biggest of the big. And although we keep expecting to have small cap rallies, et cetera, we haven't seen it. Is that inevitable because you can't let the biggest get that big without pulling others up? Or is that about index construction? Because, I kind of laugh when I hear that General Motors is a mid-cap stock, because it is now, even though it doesn't seem that way to anybody who knows the company.
And again, this goes back to that design element of indexing. And most of these large indices that we're talking about are market cap weighted. And if you want to be close to those benchmarks, if you want to have tracking error tolerances that are close to those indices, then you're going to have some level of exposure in the market cap framework just to keep pace. But again, as we start to see investors now look to pivot slightly, in some cases, more than that, moving into international markets is one way. Moving towards equal weighted or risk weighted assets is another way. And so we've seen some investor demand in that regard as well. Again, it's that rules-based, transparent methodologies that indexes provide that allow you to really understand what you're getting that you might not get with traditional active fund management. If you're investing in an index fund, you should be very well aware of what kind of weighting methodology you're getting.
And does that still hold when you start looking at some of the smart beta methodologies? Because there was a time not that long ago where smart beta was a term that was being kicked around by everybody. Now it's just been kicked kind of out of the way and had dirt kicked on it, et cetera. But there's still a lot of funds that are kind of trying to take a smart beta approach. They're just not using the word so much to call it that anymore.
Yeah, the growth of indexing certainly has made that much more challenging. But again, with any rules-based vehicle, there are pockets of some inefficiency in there that you can exploit if given that tolerance and given that budget to do so. The more folks that are investing in index funds, the more assets that are tracking the index funds, helps showcase some of those opportunities, but they have shifted over time. Those of us that have been in the index world for a very long time have seen those opportunities come and go, and newer opportunities resurface them.
Drew, really interesting stuff. Thank you so much for taking the time to join me on Money Life.
Chuck, thank you very much. Have a great rest of the summer.
That's Drew Miyawaki. He is Director of Managed Investment Solutions at the Westwood Holdings Group, which is online at westwoodgroup.com. Find the direct link if you want to learn more about Managed Investment Solutions. We will come back to put a bow on this show, and we will tell you what's coming tomorrow. And you don't want to miss tomorrow's show, so make sure you got everything primed up and ready to go, and you get with us all the way to the end. Finish line's in sight. Stick with us.
Did you know that global generalizable robotics represent a $24 trillion investment opportunity? Top robotics and AI companies are actively reshaping industries across sectors. Learn more about capturing this investment opportunity at Vetify.com.
We are back, and I have to say that interview, I try to give a lot of leeway for our guests to talk about what they want to do. In that interview with Dean Miyawaki, he's talking about an investment strategy. And as we finished the interview, he's like, could I have mentioned the name of the fund? Of course you could have. So Westwood has a Liberty Global Equity ETF. The ticker is BFRE, if you will, BFRE. That is the alternative to typical excluding China approaches that he was talking about, right? It's a very interesting tool. It addresses the autocracy risk that he was talking about. It follows the methodology, but I just felt that the interview was a bit weird in that he's kind of talking about you should have a product like this and he's et cetera without actually naming the fund. And he waited after it's like, well, I didn't want it to be a big infomercial. Okay, I appreciate you not wanting it to be a big infomercial, but it kind of felt a little bit like that portion of the interview, at least, was a bit of an infomercial without telling us what the product was. And you should be doing your own research on funds. Anything you hear here, not just because that's what the disclaimers say, but because that's if you like what something sounds like, you should want to go check it out further before you put any money towards it. But you should also understand, how do I get that? It's an interesting thing. I occasionally will hear from some of you going, hey, I'm interested in this asset class, but I don't really know how to get it. Well, in this case, Westwood has the Liberty LBRTY Global Equity ETF, BFRE, BFRE is the ticker. You can check it out. Tomorrow on Money Life, Frank Holmes, Chief Executive and Chief Investment Officer at U.S. Global Investors, will be here. Always good to talk with Frank. We've got a bunch of stuff. It's been a while since we caught up with him. We've got an interesting survey to discuss, some other things coming too. So plan to be here tomorrow. Meanwhile, if you are looking for something to celebrate, today is International Tiger Day. It is National Lipstick Day. And I will just tell you, I'm a big fan because my mom always wore lipstick. She never felt you were dressed without it. And oh, by the way, for my mom, the redder, the better, to the point where at her funeral, we literally put a note that said that all the women should wear their reddest lipstick, which they did, including like my Aunt Gertie, who never wears lipstick. And my mom, we used to joke about the mark of Evelyn, which was when my mom would give you a kiss. Somebody say, oh, I just saw your mom. Like, yeah, I can see it because it's written all over your face. Yeah, because they would have the big, et cetera. So yes, love. It's National Lipstick Day. Celebrate. It is also National Cheese Sacrifice Purchase Day. Now, look, when it comes to cheese,
Blessed are the cheesemakers.
oh, absolutely. Blessed are the cheesemakers. I'm not sure why we are supposed to be sacrificing cheese in some way. Like, are you putting it in a mousetrap? Are you breaking it off and giving it to somebody else? I don't know what you're supposed to do, why you're supposed to sacrifice cheese. I don't know, sacrifice it to like on top of a burger or nachos or something. But it's also National Chicken Wing Day. And when it comes to wings, my recipe for baked wings.
Winner, winner, chicken dinner.
Oh, yes, absolutely. Made them again last week. You can make them, actually, you can smoke them if you have a smoker for a little bit, but they're basically made in an oven and they render and they're super crispy. And I will send that to you along with my honey garlic buffalo sauce. I'll send you those recipes if you want them. I talk about them fairly often. And it's also National Lasagna Day. And I make lasagnas. You may have heard me say this. I love making lasagna. Gail and I have kind of got it down. We can be a lasagna factory every now and again. And there is an organization called Lasagna Love that makes food for people who need a meal for whatever reason. It's not necessarily that they're all, food challenged or what have you. It may be that they're going through a rough time and they need some measure of support, et cetera. I can simply tell you that while I don't do it as often as I used to because I'm just super busy, it has always been very rewarding. So it's Lasagna Love if you're looking for that organization. But even if you're not, there's never a bad day for lasagna. Although, why are they doing that in the summer when it's hot and you may not want to eat lasagna at this time of year? You always want to hear from my guests, and today's guests were Greg McBride, Chief Financial Analyst at Bankrate.com. That's the website you're going to for more information. Matt Harris, Chief Investment Officer at the Hausberg Group, hausberg.hightoweradvisors.com. And Dean Miyawaki, Director of Managed Investment Solutions at Westwood Group, westwoodgroup.com, Westwood Holdings Group. Thanks to them. Thanks to Rob Floyd, my producer. Thanks to Maho, my dog. But mostly thanks to you for being here because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from Ann M. Mulcahy, who said, as much as it's sometimes hard to make choices about where you invest, it's equally hard to make choices about where you don't invest and what you eliminate. Yeah, that is absolutely true. You want to be careful. You want to understand what you're doing. You don't want to stress too much about it, which is why I tell you every day that until we do this again the next time, the best thing you can do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
You know, that reminds me. There's something I've been wanting to say to you since the day we met. Goodbye.